Lots of talk, lots of questions about whether we're heading into another recession. Are you financially prepared? By having a good answer to this one question, you can be. I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Everything in the economy is related, and so all of the tariffs on, tariffs off, interest rates staying high, should we lower interest rates, and it's all connected. Even the stock market jitters, which is sort of responding to where the economy could be going, that at times can cause people or businesses to, we're going to pause on making some big purchases or financial decisions. That can spiral as well. And so, yeah, the big question this year with all that uncertainty is, are we about to see a recession? Are we heading into a recession? And personally, financially, you've got to answer, are you ready? Your financial situation, when you're planning proactively and appropriately, your financial situation should always be on guard for a recession. And I don't mean that you should put all your eggs in that basket and assume at any moment we're going to see a recession and therefore I can't do anything but be afraid. No. In the words of author Morgan Housel, you should be pessimistic in the short term and optimistic in the long term. Pessimistic in the short term and optimistic in the long term with your finances. And what does that mean? How do you apply that? Well, working through the comprehensive financial planning process, looking at all 6 areas of your financial life with your CFP, that's going to mean that you're always going to have some sort of margin in your budget. You're going to have an emergency fund. You're not going to take on too much debt. You're going to live within your means. But it also means that you're going to be saving up for a future. That also means that when the stock market is jittery, you're going to have a resilient sort of, we're going to be able to withstand this. We've got diversification, got the right approach, and these dollars are long term. And so you're going to hold both of those things at the same time. You're going to have the right insurances and protection, but you're also going to be planning for a future and for retirement. You're going to have your estate plan done, but you're also going to be making goals and so on for the future. That's the pessimistic short term, optimistic long term. Now, if you're not doing comprehensive financial planning and don't have the confidence that if we're going into recession, you don't have the confidence that your finances could withstand it, or even if you are, answering one fundamental question about your finances, answering it well, goes a long way in ensuring that you are prepared for a recession. Now, what's that fundamental question? Where would you get money from if you needed to get it? Where would you get money from if you needed to get it? This is back in COVID, and we went from everything's fine to we are in a recession almost overnight. This is the steepest decline in stock market history, and the fastest decline in GDP and all that sort of stuff. And the most common, surveyed in the spring, the most common frustration or challenge or issue people face with their finances is, where could I get money? And if you remember, all the stimulus and CARES Act and all these things were introduced, relaxing some of the rules so that you could actually take a coronavirus related distribution or get access to money. Of course, there was helicopter money and stimulus and everything, all to answer this question, where would you get money from if you needed to get it? Now, if we see another severe recession, I don't know if they're going to do more stimulus or change the rules again, and that created a whole bunch of inflation and whatnot last time. But even if they don't, you have to have a good answer to that question, assuming there is no stimulus and there is no relaxing of the rules. So how would you answer it? Where would you get money from if you needed to get it? Let me give you 3 options, 3 choices, 3 ways that you could answer it. And ideally, financial planning is really all about flexibility. So I want you to be able to say yes to each of these 3 options. I would hope your first answer is, I've got a fully funded emergency fund. I would hope that's your first answer, and that should be your first line of defense. If we face a recession and all of a sudden your hours get cut, your job gets cut, you're laid off, something like that, and you don't have as much income coming in, where would you get money from? I would hope that the first line of defense is your emergency fund. Why? Because you know those dollars are stable, you know they're liquid, you know that there isn't a penalty to get access to them, and there's a lot of flexibility. That emergency fund the amount of it should be, approximately 3 to 6 months of your lifestyle, of your budget. And yeah, when times are good, that might feel like wasted money or lazy dollars, but it's at these times when, okay, are you ready for a recession? That's when those dollars, that's the purpose of those dollars, not to make you rich, to keep you from going poor. So hopefully the first answer and primary answer to where would you get money if you needed to get it is, well, I've got this emergency fund. That's where I would draw money from first. Two other answers that I would inject in here as considerations for you. Hopefully you've got that emergency fund, but if you do, or even if you don't, hopefully a second answer is, I've got a home equity line of credit open and available that if I were needed to get my hands on some money, I could go access that. That you've got equity in your house and you've got an open home equity line of credit that hopefully you don't have a balance on it, but that you could draw a balance from, you could write a check from it and deposit it and get some cash if you needed to. Now, there's a couple prerequisites with this. One is that you've got equity in your home, but second is that in advance of a recession, you've set up this home equity line of credit, even though you're not using it, okay? There's a simple saying, or a sort of funny saying, but true in finances with banking. If you don't need a loan, the bank is willing to give it to you. But as soon as you need it, their bank doesn't want to lend you the money, right? If you don't have, if we go through a recession and your job, your hours are cut, your income goes down, you lose your job, and then you go to the bank and say, hey, I'd like to tap the equity in my house. Can I get a line of credit? They're going to look and say, well, you don't have any income coming in, so even though you've got this equity, you have no ability to pay this, we're not going to open this line of credit for you. Versus if you set up the home equity line of credit early, before any a future that kind of negative event happens, yeah, you've got the income coming in, you've got the equity in your house, absolutely no problem. Get that thing set up, get that thing open. Home equity line of credit is more preferable than using credit cards or other short-term borrowing tools. Why? Typically you can get more credit from your home equity line of credit. Typically you have more flexibility in your payment options, and the interest rate should be a little bit more favorable. Now, obviously interest rates are much higher right now on mortgages and home equity lines, but still most of them, it should be cheaper and lower than a personal loan or a credit card. So hopefully second answer is, yeah, I've got a home equity line of credit open, and if you don't, prior to a recession occurring, maybe look at working with the bank, getting a home equity line of credit open. And then lastly, the third answer, hopefully this is sort of last resort, but if I needed to get my hands on some money, I've got some basis in my Roth IRA that I know I could withdraw if needed. Now, the reason why I would say this is last resort, although financial planning is all about having options and choice and then deciding for your specific situation at any specific time what's the best option for you, the Roth IRA likely is going to be invested aggressively for your future, and if we see a recession, those investments likely have gone down in value. That's one. Second, if you withdraw the basis from your Roth, you have less dollars in your Roth to grow tax-free for your future and for your retirement. But the Roth IRA, the money that you contributed, even if you're not 59 and a half, or even if you're not retired, you can, even if you haven't had a Roth IRA for 5 years, you can withdraw the money that you put in, your basis, you can withdraw that at any time, no tax, no penalty. So that's another option to answer that question, where would you get money from if you needed to get it? Those are just 3 ways to answer. Can you say yes to all 3? Are there other ways? What other answers would you come up with? Having a good answer to that question helps ensure that you're prepared for a recession, whether we see one in the near future or not, or out there in the distant future. Make sure you've got a good answer to that. Work with your CFP on that. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go on and take your next wise step in your financial life.